Good afternoon. My name is Alex Islas. I am with East West Bank. I am the Community Outreach Officer, and I'll be covering comparing loan options today. I'm glad that you guys are on here. If some of you need to translate or have this translated in Spanish, there's an option there at the bottom that you guys can click, so you guys can get that going for you. So I'll just get started. So now, not all loan programs, as you can read there, not all loan programs are created equal, right? Now, what that references is that every loan is really there's three factors that make up the loan program, right? The loan term, the interest rate, and the type. Now, before we move forward, one thing I do want to make sure you guys understand is that, look, I don't want you guys to get caught up in, all of the finer details of shopping and all of that, right? It's really about understanding your financial situation, and understanding what loan program makes the most sense for you. So that's what this is about, right? So if you guys have questions as I'm going through, feel free to ask, because it's really about making sure you understand where you might fit best based on your current situation. Okay. Now, loan term, right? That's really the amount of years that it's going to take you to pay back your loan. So typically most loans that you're going to get are going to be for 30 years, right? Now, the shorter the amount of years, the higher the payment, right? Because if it's for 30 years, let's say for 30 years your payment is $1,500. For a shorter time, then that means the payment's going to be higher, right? Also, the interest rate. Typically, the shorter the amount of years that your term is for, typically the lower the rate is going to be, right? And also, the lower the amount of years that your loan is for, the less interest, because you're paying it quicker. So that's a benefit for you. Now, here are the things I kind of got ahead of myself, but again, shorter term, higher monthly payments, typically lower rate, lower cost, meaning interest, right? Longer term, yes, obviously your payment's going to be lower because it's spread out over a longer period. Typically, the rate is going to be higher, and your costs are going to be higher because you're paying a lot more interest on that. So again, it's really about understanding your, kind of your situation. Now, there are ways that you can actually shorten the term without necessarily shortening the amount of years that the loan is paid back for, right? So remember that term applies for when you first are getting the loan. So when you're applying for the loan and you say, it's going to be payable over 30 years, that is your term. But there's ways you can shorten the term throughout the life of the loan without necessarily having to commit to having that shorter term, meaning the higher payment. Now, interest rates, right? Interest rate type. Now, typically, there's going to be two major types of rates. It's either going to be fixed rate or adjustable, right? Fixed is just like it sounds. Your payments, your interest rate is going to be fixed. It's not going to change. It's going to be fixed for the entirety of the term, right? Now, this choice affects whether your interest rate can change, whether your monthly principal and interest payment can change, and its amount, how much your interest you'll pay over the life of the loan. So again, fixed rate never changes. Adjustable, it can change over time, right? It can either go up or it can go down. There's different ways. There's different caps. There's safety guards that are in place as well. So don't think that an adjustable rate is going to, jump on you from 5% to 20%. It's not. There's safety guards in place to protect you from that, but it does, again, an adjustable rate can go up on you. So that's something that when you're considering an adjustable rate, the question to ask is, what are the caps, right? What are the maximum? How often does it adjust? So you just have to make sure you ask these questions. With a fixed rate, you don't have to worry about those questions. It is what it is for the life of the loan. Now here, let's go into more detail in regards to comparing interest rate options, right? So a fixed rate, it's low risk, no surprises. It is what it is. It'll be that until you finish paying off that loan. It's going to be typically a higher interest rate. The rate doesn't change, and your monthly principal and interest payment stays the same. Now, with an adjustable rate, it's a bit riskier. There's a little bit more uncertainty. Now, the payoff for that higher risk is the fact that they give you a lower interest rate at the beginning, right? So now, typically, adjustable interest rates, they have an initial fixed rate period. Now, that period can be 1 year, 2 years, 3 years, 4 years. It could be up to 10 years where that rate is fixed. But then after that period, the rate is going to change based on the market. Now, your monthly principal and interest payment, it can go up or it can go down over time. And that is because interest rates are tied to the market, right? To a specific index, right? So as rates go up, and I know you guys, most of you have been hearing, the news, oh, rates are going up, rates are going up. Well, what happens is that if the index that your interest rate is tied to is affected by the increase in rates, then guess what's going to happen to your rate? It's going to go up. But vice versa, if your index is tied to a rate that is, that can potentially go down, as rates go down, so will your payment. Now, on the flip side, fixed rate, you don't got to worry about that, right? So that's why you're kind of compensated for that uncertainty. The offsetting factor is that you're going to get a lower rate. With a fixed rate, it's a little bit higher, but stable. So you don't have to worry about that. You just have to worry about other things, right? Like your job, your income, other expenses, but the mortgage typically is going to be the same. Now, understanding adjustable rates. So this is, if you guys look at that, it says most ARMs have 2 periods, right? A fixed period, and that's what I meant about it's kind of like the honeymoon, right? So think about it as it's a 3-year, 5-year, 7-year, or 10-year. So for those, 5, 7, 10 years, whichever you select, your rate is fixed. So you'll get a lower rate. And during that honeymoon period, you don't have to worry about your payment going up or not, right? It's after that honeymoon period that things kind of get real, right? It's either going to go up or going to go down depending on what the market's doing. Now, a second period where your rate can go up and down is based on market conditions. That's after the honeymoon period expires. Now, loan types. And I drank a little too much coffee, so if I'm going a little too fast, just shoot a note in there and let me know, okay? Now, loan types. Mortgage loans are categorized based on the size of the loan and whether they're part of any government program. Each type is designed for different situations. If multiple options are available to you, ask your lender about those options. Now, again, this is where understanding your current financial situation is really key. That way you can understand which loan best suits you. Because again, not all loans, are for everyone. So it just really depends, right? So it's really about understanding your situation. And I'll try and go into that, in detail now. Those are just my opinions as far as what I think. I see a note there. And okay. Now, conventional loans. So the 2 types of loans that you guys are typically going to have are your government-backed loans and your conventional loans. So now we're going to talk about conventional loans. A conventional loan is a loan that is not part of a government program, right? Now, conforming versus non-conforming, that is based on the size of the loan that you're provided. Okay, so I don't want to get too into that detail, but it's the loan, the size of the loan that you're getting. Now, typically conventional loans are less expensive than FHA loans, but they may be a little bit harder to obtain. Not all the time, but they are. Now, some lenders provide conventional products, specially designed for first-time homebuyers. Now, let me go back to that part where it says, you know, FHA typically costs less than FHA, but may be harder to approve, right? So what happens is that, think about a conventional loan as a loan that requires you to pretty much have all your ducks in a row, right? It doesn't mean you have to have amazing, 800 FICO and make $500,000 a year. It doesn't mean that. It just means that you typically are going to have to fit in that box of, you're going to have pretty good credit. You're going to have your income pretty much in line, nothing tricky. Your down payment and closing costs or funds to close are going to be pretty much, you're going to have that pretty much set, right? That's what a conventional loan means. It's more, basically kind of like the word, right? It's conventional. It's nothing really outside the box, right? But just like with the what I spoke about, adjustable versus fixed, the benefit of a conventional loan is that it's going to be a little bit cheaper for you to get, right? So when we say cheaper or less expensive, is the fees that are associated with the loan, right? So they require you to have pretty much your ducks in a row, but the offset is that it's a little bit cheaper to get. Now, FHA loans. FHA loans from private lenders backed by the federal government. Now, the federal government doesn't make loans. They just provide support or insure them. The down payment typically is as low as 3.5%. It allows for lower credit scores than most conventional loans, and maximum loan amounts are a little bit higher. But it does come with permanent private mortgage insurance. Now, I see a question there, so I'll go and take the question. Let's see. At what time can you change the type of loan after you have closed? Well, there's really no. So someone asked this: how soon after you've closed on your home, how soon you can change the loan term? And the answer is there is no set amount of time. But remember that that would be a refinance. So when you're doing that, you have to requalify for a whole new loan, right? So typically you're not able to do it, within a month or so. You typically it's going to take you, at least 6 months, because you have to requalify for that. But there is no limit. Okay, so back to FHA loans. So now, like I mentioned, the federal government doesn't make loans. What they do is they provide insurance. So what they do is, because remember, on a conventional loan, I mentioned that you got to have your ducks pretty much in a row, right? FHA allows your ducks to be a little bit kind of, not so orderly, right? If life happened and you have some credit issues, or if your income's a little, tighter than you'd like, for whatever, things that are outside the box, FHA allows you to get into a home. But remember, it's a little bit more expensive, right? Now, what FHA loan does is, what FHA does is, because they're providing that insurance, it motivates the banks to lend to you, even though your ducks are a little bit out of whack at the moment. You see what I'm saying? So that's the offset. It's that permanent private mortgage insurance that you guys see at the bottom of that slide. That is the assurance that FHA gives lenders to go ahead and lend to you, right? So basically, it's like FHA pays insurance on you because your ducks are a little out of whack. That motivates the bank to lend to you. But yeah, they lend to you, but it's a little bit more expensive to get, right? Now, VA loans. VA loans for veterans, they're offered by the Department of Veteran Affairs for eligible veterans, service members, or surviving spouses. These loans typically don't have PMI. and they're backed by the VA. They're available with low or zero down payment. And for some buyers, it may be more expensive. It may be a little bit more expensive than conventional loans, but it has no monthly PMI. I think if you're a veteran, there's really no other option. I mean, there are other options, but what I mean is there's no better option for you than a VA loan. The rate may be a little bit higher, right? It may be a little bit higher, but again, that's where you can go and shop for, in comparison to like a conventional loan or an FHA loan. So again, it's about, but I think as a veteran, it's a pretty good option for you guys to consider. Now, USDA loans, Department of Agriculture, designed for low to moderate income buyers in rural areas. It's a great option as well. It offers 0 to very low down payment. And some of these have PMI, some of them don't. But again, it's a great option for folks that are looking to purchase in rural areas. Now, first-time homebuyer programs can come in conventional. They can come in FHA. So now the definition of first-time homebuyer is somebody who hasn't owned a home in the last 3 years. Now, typically that's what the definition is. So don't think that, well, I used to own a home 6 years ago. I'm no longer a first-time homebuyer. No, it just means you haven't owned a home in the last 3 years. So now many lenders and nonprofit like Dallas Habitat provide loans specifically for first-time homebuyers and or low to moderate income buyers. They can be conventional loans with as low as 3%. Some of them may not require PMI, and some of them may include down payment assistance. Now, again, this information, this session is really for you guys to just make notes, right? So if some of you guys have never heard of down payment assistance, right, that's when you can circle back to Dallas Habitat and inform yourself about down payment assistance, how it works, how it helps. What are your responsibilities? What do you need to have on your end to be able to get that down payment assistance? Same thing with, there's loans that may not require PMI or an upfront fee. So what happens is that not all loans, whether the conventional loans, require PMI, even though you're putting 20% less than 20% down. And so what happens is, again, that's a little note you should make, right? Is what loans don't require PMI, even though I'm only doing 3% down. So again, this is more to pique your interest and make you want to ask certain questions. And the best people to ask that question is to Dallas, right? Dallas Habitat. And that's all you guys right there, raising your hands, asking me questions. So we got through it a little bit quicker than we thought, but yeah, if you guys have any questions, let me know. If I went a little too fast, let me know. So I'm kind of all ears. All right, let me go in here and pick. Yeah, go ahead.
Yeah, no, I was to say, Alex, it looks like we don't have any questions.
Okay.
Yes, but what do you think is the best rate, or what are one of the loan options that people would be able to qualify based on today's current market?
Well, I think that's a good question. So what happens is that home buyers, and it happens to all of us, right? Is we get caught up in kind of like the news, right? We get caught up in what we hear. As far as, rates are going up or houses are going down. So we get caught up in the wave of momentum, right? Of what we're hearing. There are loans out there, from different institutions, right? That are going to offer you rates that are below market. And I know that, you know, when you go out and you talk to you know, the uncle or the grandma or your own parents or, you know, friends or whatever, some of them may say, you know what, it doesn't sound right. But the fact is that there are banks that offer you loans with no PMI, right? Loans with, you know, conventional loans with, you know, close to no fees or no fees and lower rates. So what happens is that there are a number of institutions, Porfirio, you know, including ours, that do offer extremely low rates. But again, it's on folks to want to get that knowledge, right? Whether it's through you guys, through the counseling, or just kind of just doing research, right? Because there are loan programs out there that are not, where the rates are not, you know, are below market.
Thank you so much, Alex. I do have a question here in the chat. It says, what are some of the ins and outs of a USDA loan?
That's a good question. I mean, look, the ins and outs are, I can just tell you the bare minimum of what I'm aware of is there are income limits, there are area restrictions. So you would have to, the best thing you could do is go to the USD website, and they're going to give you the income limits by county or by area. And then you'll also be able to see the eligible areas, because it has to be in a rural qualified area. So you have the income limits, you have the location limits, but in regards to the flexibility of, as far as like the loan, I've seen people with as low as 580 being able to do some of these, and with as little as 0% down as far as down payment. So it is a great loan for if you're looking for those, you know, to buy in those rural areas. I think it's an amazing program.
Thank you, Alex. So another question that attendees have is that what is the difference between choosing a conventional loan and an FHA loan?
Well, look, the difference is your situation. So a conventional loan is, you know, like I mentioned, it's a pretty, not tight, but it's a pretty, you know, it's a box that is not that flexible. Now, I'm not saying that's a bad thing, right? It's just going to require that typically conventional loans, they could be a little bit flexible with your income, but the part of a conventional loan that's a little bit not as flexible in regards to assisting you with your down payment or assisting you with your closing costs. So you're going to have to, if you want to get a conventional loan, you're going to have your funds to close, which is going to be your down payment and your closing costs. So you're going to have that either coming directly from you or coming from, you know, from a gift. But you're going to have that pretty much, you know, it's going to be pretty much needing to come from you or from a gift. FHA, on the other hand, is very flexible when it comes to income, but it does give the lenders a lot more flexibility when it comes to assisting you with covering some of your closing costs, right? Now that comes at an expense, right? Because if lenders cover some of your closing costs, typically what they're going to do is they're going to increase your interest rate. So there's a cost to that. But don't be afraid of the cost, because it's better than renting, right? But again, that's really the biggest difference, I think, is the income portion a little bit, the credit portion's a little bit, FHA is going to be a little bit more flexible. But the biggest, in my opinion, the biggest difference is that FHA gives lenders the ability to really help you when it comes to paying for some of your costs. Now, if you could save up money, right? If you could save up money and just go on a really tighten your budget for, you know, 2-3 months, I'm always going to suggest that you go the conventional route because it's a much cheaper loan. The PMI is less expensive, and you can get out of the PMI. With an FHA loan, it's always going to be more expensive, and you can get rid of the PMI. But those are kind of like the two major differences.
Thanks so much, Alex. So what about if I have like an FHA loan? Could I drop the private mortgage insurance premium after I reach like 20% equity, like a conventional loan?
Well, no, you can't, and that's the catch, right? Is that on an FHA loan, that PMI. So let me backtrack. Private mortgage insurance is typically an insurance that you have to pay on the loan if you're putting less than 20% down payment. So if you're doing 3% down or 5% down, normally you're going to have to pay mortgage insurance. Now, your payment is going to include, so I use this a lot, right? But I say your payment, think of your payment when you guys buy your homes, or the people that have homes, think of your payment as a pizza, right? And that pizza is divided into 4 different slices: your principal, your interest, your taxes, and your insurance. That is if you're putting 20% down. If you're putting less than 20% down, then that pizza is going to get sliced up into 5 different pieces. It's going to be your principal, your interest, your taxes, your insurance, and your PMI, right? So what that's going to do is it's going to increase your payment, because we're adding another slice to that pizza. So it's going to increase your payment by whatever the PMI monthly portion is. On a conventional loan, if you're putting less than 20% down, you can get rid of that slice at a given time in the future, once you've achieved 20% equity, right? So you can throw that slice out. Now it's back to 4. On a conventional loan, your pizza will always be divided into 5. Doesn't matter how much equity you have, as long as you have that. As long as you have that same loan that you bought the house, you can't get rid of it. The only way you can get rid of it is by refinancing the entire loan onto a conventional loan to get rid of the PMI. So I made the answer a lot longer, but
No, that's a good answer. That's a good answer to that. Now, like, when comparing different types of loans,
yes.
what are some things that you will look into? For example, if you have 2 FHA loans, let's say, for instance, you've been pre-qualified with East West Bank, and then also you've been pre-qualified with XYZ Bank. What do you look into that to compare those 2 loan options?
Well, you guys go and you guys shop your loan, right? Which is what you're supposed to do, right? That's what this session's about. So you go and you get your 2 options. The first thing I look at is look at your payment. Don't look at your rate. And I know that may sound a little weird, right? But look at your payment, because at the end of the day, what you write on your checkbook, well, not anymore, right? We don't write our payments on a checkbook, but what you send out on the automatic payment or whatever comes out of your account is not a rate, it's a payment, right? So the first thing is look at the payment and the breakdown of the payment, right? Your principal and interest, your taxes, your insurance, and if there's any PMI. So that's the first thing. Then the second thing you look at is how much is it costing you to get that, right? Because you may have a lower payment, but you may also have a lower rate. But what's the cost? How much is it costing you, right? And how does that affect the amount of money you have available to close that transaction, right? So number 1, payment. Number 2, how much it's costing you to get. And then number 3, I look at the rate, because the rate is a representation of all those 2 other things that you check, right? Because, okay, I see my payment, I see how much it's costing me, boom, now I see the rate. Because a lot of folks, what they do, and this is because of just, it's natural, right? You're gonna look at that rate first, and then you're gonna fall in love with the rate. And then your mind it's subconscious. So you subconsciously, you're gonna say, I got the lowest rate. But then you're not really looking at how much it cost you and what effect is it truly having on your payment, right? So that's what I always say, is look at the payment, the cost, and then the interest rate.
Great. Thank you so much, Alex. Any other questions from our attendees? Alex, that was great information. Thank you so much for joining us today.
No problem. Good luck to everybody.
Thank you.
All right, bye-bye.